February 7th, 2026. I was reviewing overnight precious metals trading when something made me immediately call my contact at a major European bank. Gold had just crossed 2,780 per ounce, while silver exploded to 54. Both metals up over 8% in a single trading session. But what made this truly alarming wasn't the price surge itself. It was the emergency meetings being called by bank risk management departments worldwide. "Claude," my banking contact said, his voice tense with worry I'd never heard before. "We're not just looking at precious metals rallies anymore. We're looking at the systematic destruction of bank balance sheets. The short positions these institutions have been carrying for years are now threatening their existence. When gold hits $3,000 and silver reaches $75, and we are going to see bank failures that make 2008 look like a minor correction." The mathematics were staggering. Major banks had accumulated an estimated $480 billion in short positions across gold and silver markets, betting that precious metals would decline as central banks maintained control over inflation and currency stability. Instead, the opposite was happening with violence that was destroying decades of careful risk management. But here's what made this truly extraordinary. The precious metals surge wasn't happening in isolation. It was the direct result of accelerating dollar depreciation driven by money printing, exploding government debt, and inflation that had broken free from central bank control. The financial system wasn't just facing a precious metals crisis, it was facing the terminal phase of dollar credibility collapse. My banking contact put it perfectly. The dollar is dying, precious metals are screaming higher, and banks are trapped in positions they can't exit without triggering the very crisis they were trying to prevent. We're watching the controlled demolition of the global financial system, and most people have no idea what's coming. The precious metals price explosion that's breaking banks. The current gold and silver rally represents more than investor flight to safety. It's a mathematical reckoning that's systematically destroying the balance sheets of institutions that bet against monetary metals while central banks debased their currencies. The scale of bank short positions. Intelligence analysis suggests that major banks hold approximately $340 billion in gold short positions and $140 billion in silver short positions across COMEX futures, London forwards, and over-the-counter derivatives markets. These positions were accumulated over years as banks collected fees from clients wanting precious metals exposure while betting that central bank policies would keep gold and silver prices contained within predictable ranges. The leverage amplification effect. Most bank precious metals positions are heavily leveraged, meaning small price movements create disproportionate losses. With average leverage ratios of 1520.1 on precious metals positions, every $100 increase in gold prices creates $500, $2,000 in losses per position. At current gold levels of $2,780, banks with $1,000 gold short positions face approximately $18,000, $24,000 in unrealized losses before considering compounding effects and margin calls that force additional capital deployment. The liquidity crisis development. As precious metals prices rise, banks face margin calls on short positions that require immediate cash deployment at precisely the moment when their other assets are declining due to rising interest rates and economic uncertainty. This creates a liquidity squeeze where banks must sell performing assets to meet margin calls on losing positions, accelerating the asset price declines that created their liquidity problems initially. The systemic risk multiplication. Unlike equity or bond positions where losses are limited to the amount invested, short positions in rapidly appreciating assets create unlimited liability that can exceed a bank's capital base if price movements are sufficiently extreme. Banks that survive individual precious metals losses may still face insolvency due to counterparty failures, as other institutions collapse under similar pressures, creating cascade effects throughout the financial system. Dollar depreciation. The root cause of banking crisis. The precious metals surge that is destroying bank balance sheets is the direct result of accelerating dollar depreciation driven by fiscal and monetary policies that have destroyed confidence in dollar stability. The money printing acceleration. The Federal Reserve's balance sheet has expanded from $4.2 trillion in 2020 to $9.4 trillion in early 2026, representing a 124% increase in the monetary base in just 6 years, the fastest peacetime money creation in American history. This monetary expansion has created inflationary pressures that central bank officials consistently underestimated, leading to policy responses that were too little and too late to maintain price stability or currency credibility. The debt spiral mathematics. Federal debt has grown from $27 trillion in 2020 to $38 trillion in 2026, with annual interest payments consuming 34% of tax receipts and rising rapidly as existing debt refinances at higher interest rates. Mathematical projections show debt service costs reaching 50% of tax receipts by 2028, creating a fiscal death spiral where government borrowing to pay interest accelerates the debt growth that requires additional borrowing. The international confidence collapse. Foreign central banks have reduced Treasury holdings by $680 billion since 2022, while increasing gold reserves by 2,400 tons, signaling systematic diversification away from dollar assets toward monetary metals. This international dollar rejection forces the Federal Reserve to monetize increasing quantities of Treasury issuance, accelerating the money printing that drives currency devaluation and precious metals appreciation. The inflation breakout reality. Consumer price inflation has exceeded official Federal Reserve targets for 18 consecutive months, with core inflation reaching 6.8% in January 2026, despite aggressive interest rate increases that damaged economic growth. Rising inflation expectations are becoming entrenched in wage negotiations, pricing decisions, and investment strategies that create self-reinforcing inflation dynamics beyond central bank control through monetary policy alone. Banking sector. Vulnerability, the perfect storm. Banks face multiple simultaneous pressures that are converging to create the most dangerous operating environment since the 1930s, with precious metals losses being just one component of broader systemic risks. Commercial real estate exposure. Regional and community banks hold approximately $2.7 trillion in commercial real estate loans, with office properties facing 40 to 60% value declines due to remote work trends and rising interest rates. Commercial real estate loan defaults are accelerating rapidly, with delinquency rates reaching 8.3% in Q4 2025 compared to 2.1% in Q4 2023, creating loan loss provisions that are devastating bank earnings and capital ratios. Unrealized securities losses. Banks hold approximately $620 billion in unrealized losses on securities portfolios purchased during the low interest rate period, with losses accelerating as the Federal Reserve maintains restrictive monetary policy. These unrealized losses become realized when banks need liquidity, forcing asset sales that crystallize losses while reducing the capital base available to absorb additional shocks from precious metals or other exposures. Deposit flight acceleration. Bank deposits have declined $890 billion since March 2022 as customers chase higher yields in money market funds and Treasury bills, forcing banks to rely on expensive wholesale funding to maintain operations. The deposit flight reduces stable funding while increasing interest costs, compressing net interest margins at precisely the moment when banks face loan losses and trading losses that require strong earnings to absorb. Credit loss, provisioning, rising unemployment, consumer debt stress, and business failures are forcing banks to increase loan loss provisions by an average of 340% compared to 2023 levels, consuming earnings that would otherwise support capital ratios. Credit losses are accelerating across all loan categories as economic conditions deteriorate, with particular stress in consumer credit cards, auto loans, and small business lending, where default rates are approaching 2008 levels. The liquidity death spiral banks facing precious metals losses, commercial real estate write-downs, and deposit flight are entering a liquidity death spiral where each problem amplifies the others until institutional survival becomes impossible. The forced asset sale cascade. When banks face margin calls on precious metals, positions, or deposit withdrawal demands, they must sell liquid assets to raise cash, typically starting with Treasury bonds and high-grade corporate securities. But asset sales during market stress realize losses that reduce capital ratios, triggering additional regulatory requirements that force more asset sales in an accelerating cycle that quickly consumes available capital. The counterparty risk amplification. As individual banks weaken, other financial institutions reduce their exposure by limiting credit lines, refusing to roll over wholesale funding, and demanding additional collateral for derivatives positions. This counterparty risk management creates funding stress for vulnerable banks while concentrating exposures among stronger institutions, setting up systemically important banks for catastrophic losses when weaker institutions fail. The regulatory capital squeeze. Bank regulators require higher capital ratios during stress periods, but rising loan losses and trading losses are reducing available capital at precisely the moment when regulatory requirements are increasing. Banks facing capital adequacy problems must either raise expensive equity capital in hostile markets or reduce assets through fire sales, both options that weaken the institution and reduce its ability to survive additional shocks. The market confidence collapse. As news of bank losses and liquidity problems spreads, depositors, creditors, and shareholders lose confidence, accelerating the deposit flight and funding stress that created the initial liquidity problems. Confidence collapse creates self-fulfilling prophecies where concern about bank survival causes the deposit flight and credit restriction that actually threatens bank survival, regardless of underlying asset quality or management competence. The structural crisis timeline. Based on current financial stress indicators, precious metals price trends and historical banking crisis patterns, here's how the developing crisis will likely unfold. Phase 1, recognition and denial. Q1, Q2, 2026. Bank management and regulators acknowledge precious metals losses and commercial real estate problems, but characterize them as manageable within existing capital buffers. Media coverage focuses on individual bank problems rather than systemic risks, while bank stocks decline steadily as investors recognize the scope of developing losses before official acknowledgement. Phase 2, capital raising desperation, Q2, Q3, 2026. Banks attempt to raise capital through equity offerings, asset sales, and dividend cuts, but market conditions make capital expensive while asset sales realize large losses. Several regional banks fail due to inability to raise capital or maintain liquidity, creating depositor panic that spreads to institutions with similar exposures or funding profiles. Phase 3, systemic recognition, Q3, Q4, 2026. Regulators and political leaders acknowledge that banking problems are systemic rather than isolated, triggering emergency policy responses, including deposit guarantee expansions and emergency lending facilities. Precious metals prices accelerate higher as emergency policy responses confirm currency debasement fears while demonstrating that the financial system cannot survive without continuous government support. Phase 4, system restructuring, Q4, 2026-2027. Major bank failures. Forced consolidation of the banking system under government control, while emergency policies blur the distinction between fiscal and monetary policy as survival becomes the primary objective. This phase features rapid changes in financial system structure, payment mechanisms, and currency arrangements as authorities prioritize system survival over traditional economic principles or constitutional limitations. The impact on ordinary Americans. The developing banking crisis will affect ordinary Americans far beyond stock market losses or investment account declines, potentially disrupting the basic financial infrastructure that modern life depends upon. Bank account access disruption. Bank failures and emergency restructuring could temporarily freeze access to checking and savings accounts, while federal agencies work to transfer deposits to surviving institutions. Even FDIC-insured deposits may face access delays during bank failures, potentially creating cash flow problems for families and businesses dependent on predictable access to their funds. Credit system breakdown. As banks focus on survival rather than lending, credit availability will decline dramatically for mortgages, auto loans, credit cards, and business financing that supports economic activity. Small businesses and individuals with marginal credit profiles will find credit unavailable at any reasonable interest rate, forcing economic adjustment that reduces consumption and employment throughout the economy. Payment system stress. Electronic payment systems depend on bank infrastructure that may face disruption during crisis periods, potentially forcing temporary return to cash transactions for daily commerce. ATM networks, credit card processing, and electronic fund transfers could face intermittent disruption as banks focus resources on survival rather than maintaining normal operational capabilities. Real estate market collapse. Bank failures and credit restriction will devastate real estate markets as mortgage lending becomes unavailable while banks liquidate foreclosed properties to raise capital. Home values could decline 40-60% in many markets as sellers compete with bank-owned inventory while potential buyers cannot obtain financing, eliminating home equity that many families depend on for financial security. Preparing for financial system breakdown. Understanding the developing crisis provides opportunities for preparation that can protect individuals and families from the worst effects of banking system collapse. Cash and physical assets. Maintaining higher cash reserves and physical assets, precious metals, real estate, commodities, provides security independent of banking system stability. Physical assets retain value during currency debasement while providing security that cannot be frozen or seized during bank failures or emergency government interventions. Banking relationship. Diversification, spreading deposits across multiple institutions and jurisdictions, reduces exposure to any single bank failure while maintaining access to funds during crisis periods. International banking relationships provide access to financial services independent of domestic banking system problems, though regulatory restrictions may limit this option for ordinary citizens. Debt reduction and fixed rates. Reducing debt exposure while locking in fixed interest rates provides protection against both credit availability restrictions and interest rate volatility during crisis periods. Variable rate debt becomes particularly dangerous during financial crises as banks raise rates to maintain profitability while credit availability declines for refinancing purposes. Essential services and supplies. Maintaining stockpiles of essential goods and developing relationships with local suppliers provides security during disruption to electronic commerce and credit systems. Local relationships and physical goods become more valuable during financial system stress as electronic systems face disruption and supply chains reorganize around cash transactions. The mathematical evidence is overwhelming. Dollar depreciation is accelerating due to unsustainable fiscal and monetary policies. Precious metals are rising at rates that are systematically destroying bank balance sheets. Banking sector vulnerabilities are converging to create the most dangerous operating environment in generations. The financial system is heading towards structural crisis that will force fundamental changes in banking, currency, and payment systems. The timeline is accelerating as each crisis element amplifies the others in self-reinforcing cycles that authorities cannot control through traditional policy tools. Those who recognize these trends and prepare accordingly will weather the crisis successfully. Those who assume the current system will continue indefinitely will face devastating disruption to their financial security and economic prospects. The banking apocalypse is beginning. The dollar's credibility is collapsing. The precious metals explosion is just getting started. The controlled demolition of the global financial system has begun.